Hi, everybody. Thanks for joining us, as Jack said, for this webinar presented by Vixio on the question of whether rising taxes in U.S. sports betting are a growing concern for stakeholders in the gaming industry. It's great to have you with us today. Looks like we have a great crowd. As Jack said, my name is Matt Carey. I'm a reporter in the U.S. for Vixio Gambling Compliance. A lot of my focus is on the evolving sports betting and online gaming market here in the U.S., and I'm really excited to have a great panel this morning that represents a lot of different perspectives in the industry. Before we get started, I just wanted to give those of you who are new to Vixio a quick introduction as to who we are and what we do. Vixio is a reg tech company that provides independent regulatory intelligence for those in the gambling and payments industry, including compliance professionals, regulatory personnel, corporate strategists, and so much more. For more information on Vixio, I'd like to encourage you to visit Vixio.com to learn more about our platform. We've also got some great free content I'd advise you to check out, including our most recent US iGaming Outlook, as well as some of the past webinars and podcasts we've done on topics like the UK Gambling Act review and the ongoing evolution of the Brazilian regulated market. As for today, let me introduce the panel we have to talk about sort of US sports betting tax policy and how it's really evolved in the last few years. First, we're thrilled to have Scott Ward, a partner with Orrick, Harrington, and Sutcliffe. The firm represents, among others, the Sports Betting Alliance of FanDuel, DraftKings, BetMGM, and Fanatics. I think I got all four. Scott's been on the front lines for years in state houses throughout the U.S. talking through gaming policy with lawmakers, and I'd say there's probably not many people in the industry who are as familiar with how the process works than Scott. Next, we've got Chad Bynan, Senior Equity Analyst and U.S. Head of Research for Macquarie. Chad has tons of experience analyzing the gaming industry, both in the online and land-based space, and he's seen the impact that these sort of policy decisions have had on these companies, both in public markets, and then how they influence decision-making, both by the companies and those who invest in them. And last but certainly not least, we have my colleague at Vixio, our Chief Analyst, James Kilsby, who's been on top of this issue as it's continued to develop over the last few years. James has studied how tax policies continue to evolve from the early days post-PASPA in 2018 up until today. James is also a co-author on our most recent US Sports Betting Outlook, which featured a deep dive into this issue and some of the themes we'll talk about today. So all three of you, thank you guys so much for joining us. I'm looking forward to the conversation here. So to quickly summarize this issue without sort of stealing the panel's thunder here, as we go here, we'll have this discussion. As Jack said, we'll have audience questions. I want to leave some time at the end for audience questions, so please feel free to send questions throughout. If I see one that pops up as a good follow-up, I'll ask it quickly, but if not, we'll definitely try and get to some questions at the end. So yeah, to summarize the issue, I'd say most early adopters in the early post-PASPA days enacted tax rates ranging from around the Nevada standard, which is 6.75% of GGR, to about somewhere around 15% range, with some exceptions. Pennsylvania was an early exception to 36%, although they were also one of several states that permitted operators to fully deduct promotional play from taxable revenues, which really lowered their effective tax rate. Over the last few years, we've seen a little more variance, including maybe the most notable variance, which is New York, where 9 operators agreed to pay a 51% tax rate after a competitive bidding process with no promotional deductions. Then in the last year or so, we've seen the first states go back and revisit existing tax rates, with those Ohio lawmakers in 2023 doubling the tax rate from 10 to 20%. We saw Tennessee shift from a 20% tax on GGR to a 1.85% tax on handle. That's the only handle tax in the US. And most recently, Illinois moved from a set 15% tax to a graduated tax rate that goes as high as 40% on the top earners, which historically have been FanDuel and DraftKings. We've also seen other states like Colorado and Virginia, they've made smaller reforms restricting the amount of promotional play that operators are permitted to deduct. So after that long build-up, the central question of the webinar is whether these recent tax increases we've seen are simply isolated state-specific incidents, or are they the beginning of a trend where more states are beginning to revisit their own tax rate? And Scott, I will start with you. Where do you land on that central question generally?
Thanks, Matt. And I guess I'm going to give you the lawyer's answer here, that it's both. All three of those examples you gave, Ohio, Tennessee, and Illinois, are isolated. The reasons they did them are particular to those states, and I can talk a little bit about that. But there is going to be a trend here. We're going to see more states talking about this. Just real quick, Ohio did it because Mike DeWine, the governor, was unhappy about all the advertising and the negative press that occurred right after, sort of the stumbling that we had right out of the block there in Ohio in January. When you legalize, what did they do? It's not. I think they legalized up to 25 mobile sports books, kiosks and bars and grocery stores, and then a handful of retail, all going online at the same time. There's a lot of advertising. And he took offense to that and included it in his budget. It really wasn't about money at all in Ohio. They didn't, the number that they were trying to get to, we'd already exceeded the amount of tax dollars that were supposed to come in for that first year. We'd already done it in 6 months. So it really wasn't about the money at all. It was about his upset about the advertising. Tennessee did it because it was really a way to get out of their unique law relating to the 10% hold requirement that Tennessee had in reg, but not in statute. And so they went to a handle tax as a way to eliminate the hold requirement that none of the licensed sportsbooks in the state were able to meet. And then actually, 1.85%, I'll leave the math to Chad. Again, I'm a lawyer, I don't do math, but 1.85% handle, frankly, is a little bit of a tax decrease for some of the folks that were paying, for some of the operators in Tennessee from the 20% with the 10% hold. And then Illinois was about the money, but it was we were told when it was first put in the budget that it was just a placeholder. They just needed something to throw in there. The lesson learned there is that once you get on the list, it's hard to get off that list. And of course, we saw what happened there as that debate evolved. But we are going to see this happen in more states. We have been passing sports betting in relatively positive budget environments. These states have been in surpluses for most of the time we've been doing this since 2019. That's changing now. We're going to see deficits. And so as you see some of these deficits, they're going to go back and look, particularly these early states that have lower tax rates, go back and look for ways to raise tax revenue, and we'll be on the list.
Chad, how do you see it, and how do you think the market has seen it in general? We saw an interesting reaction to, especially the Illinois tax rate, a state obviously it's material to a lot of these companies' business bottom line. So I guess, like I said, how do you see it, and how do you think the markets responded to it?
Sure, thanks, Matt. And yeah, Scott, great kind of review of what we've seen so far, and kind of what you're projecting. I would say the market is certainly not as ingrained in the nitty gritty as much as us and some of the attendees on this webinar are. I would say from an initial reaction standpoint, DraftKings stock was down 10% the day that this was announced. Flutter stock was down 7%. So clearly, there was market value that was coming out. All of these companies, mainly DraftKings and Flutter and MGM, Caesars, et cetera, are running a business with a goal of 20 to 30% EBITDA margins. So they kind of created a cost framework that had somewhat of a fixed line item in there, and that was taxes. So for most of these companies, they've thought about taxes in the 15 to 20% range. So clearly, if you do start to see a trend, that means the long-term EBITDA margins of these companies, the terminal values of these companies, the overall valuation of these companies needs to be discounted. And that's what we saw on day one. Since then, I'd say, some of these names in the digital space have earned some of that market cap back. Tonight, we actually start some of the digital companies reporting earnings. So we have Caesars Entertainment tonight. Next Friday, we have DraftKings, and that'll certainly be a big one. We saw Entain and the BetMGM JV numbers this week as well, and they were, from our perspective, slightly below expectations. So I think the market is certainly still digesting what this means for companies. We have seen negative estimate revisions for the back half of 2024 from an EBITDA standpoint, mainly for DraftKings, given the impact from Illinois that I think most analysts are, viewing as roughly, a little bit below $100 million of EBITDA impact. So then the question, yes, would we see further states do this? My 20 years covering gaming, particularly the land-based gaming side, I would say no. But I think the regulators and the lawmakers just understood what a tax increase would mean for jobs in the market. That was something going back to New Jersey in the Chris Christie days and supporting Atlantic City. Most of these regulators know that if you change the business model, there will be job cuts. In this instance, that's kind of the varying factor. There won't be as many job cuts. There will just be a change in the business model. DraftKings has been very open in terms of saying we will either reduce sales and marketing or we will reduce promotions because we have financial goals and financial margins that we're looking to achieve. But yeah, I don't think there's going to be, a complete mulligan, so to speak, for most of these legislators. But there are some rooms for increases here. And then I'd say the last thing on this question is I think it goes back to the core point of consumer protectionism, right? One of the big hot issues when sports betting and iGaming were legalized was what is the black market and what is the business model that needs to be run to move people above ground, have better consumer protectionism laws, and then also keep people from going back there so you get your tax revenues. So several of the companies that I cover have said if taxes are too high, we will make adjustments to our model and you will start to see players move back to the black market. And in some of the due diligence that we've done, it's still a very large market, despite the numbers that we see on a monthly basis here.
James, I'm going to turn to you next. This is a topic we covered really at length in our most recent U.S. sports betting outlook. What are some of the factors that go into analyzing whether this is, state specific? I mean, Scott mentioned a bunch of the state specific factors that go into it. Chad's mentioned a couple of the company specific factors that go into it. And, so what are the factors we look at in terms of determining whether it's trend or not? And what are some of the pros and cons as to whether it is?
Yeah, I think just to piggyback off what Scott and Chad have both shared, I actually think not only is this trend to Scott's point, it was probably an inevitable conversation that we would end up having a few years into this post-PASPA era. And I think that in large part comes back to Scott's you've got to think about the circumstances and the context at the time when many states did legalize mobile sports betting at that period, roughly sort of 2019 through 2021. To Scott's point, that was a time of budgetary surplus, unprecedented budgetary surplus with COVID stimulus money for some of the later adopting states. So there was the sports betting when it was legalized by a majority really of the states that do have mobile sports betting. Revenue raising was not a stated goal at that time. I think if we think about also the context of how states and why states have legalized gaming, land-based casino gaming, sometimes that is done for tourist development and to create resorts that will drive convention traffic or otherwise. But there's a number of states that have legalized casinos and done so claimed to be reluctantly as a budgetary driver. So applied a high tax rate to casino gaming to sort of get around a reluctance to legalize gaming. That did not happen with sports betting. The rapid rollout, I think, reflected the fact that this was politically and publicly popular to legalize sports betting at the time, and I don't think there was pressure on most lawmakers to apply a higher tax rate to sports betting to get it over the line. There are some exceptions, New York being the very obvious one, but I don't think tax rates was not really a point of friction when it came to legalizing sports betting in most states, with some notable exceptions. And those things are starting to change, right? The budgetary situation is changing at state level. And the perception of sports betting, and again, I think the point around Ohio circumstances is a good one. There is more scrutiny on the sports betting industry from a kind of responsible gaming and advertising standpoint. I think probably, again, inevitable based on what we know about international markets and how they've come under regulatory pressures after liberalization. So I think when you sort of add those factors together, it's not a surprise at all that we are having this conversation now, thinking about which states may be contenders to raise taxes later. So that would be to support what Scott and Chad said. It's not a surprise that we're at this point. And I just would add, absolutely, I do think it's important to take away from, particularly coming out of Illinois, that has sort of had a big reaction within the industry, within the public markets. What was it, Chad? You said we're not going to see every state have a mulligan and redo their tax rates. There isn't. The precedent of land-based gaming suggests actually many states will stick with what they started off with, and there'll be a lot of state by state nuance here. We're not going to have a reset of tax rates where every state arrives at one consistent defined rate. There'll be a lot of state-specific factors. I think it's fair to say there'll be some. Talked about Ohio and Illinois where tax rates have been proposed and then implemented. The likelihood is we'll see some proposed and defeated, and the industry will be able to back some efforts to increase taxes. And we have on the screen there Colorado and Virginia about doing more subtle changes to address promotional deductions. So I think this is an area that's going to see a wide range of proposals and a wide range of responses. And this is going to be a sort of a moving target from a policy point of view, probably over the next 2-3 years or longer, and that's something that's frankly not tremendously surprising.
First, before I keep going, I want to again invite questions from the crowd. Starting to see some roll in. Please feel free as we go to pop in with a question. I want to jump to Scott. James mentioned, the point at the end there that I wanted to piggyback off of. Sort of, this is going to be, a conversation that, in some states are going to could be an industry success. Some states could be, the opposite. Legislators, regulators are always watching what other states are doing on this front. What is the pitch from the operator side for a state that would consider a tax increase? Particularly you've got some of these states that are very much on the lower side of the national average, seeing their neighbor at a much higher tax rate. So, when you're going into the state house and trying to bat down a tax increase, what is the pitch?
Well, first of all, thank you, James, for saying that you think some of them will be defeated. I wholeheartedly agree with you on that. Since I'm going to be one doing that. So it's state by state. Of course, there's some overall issues that are always going to be there, but every state is a bit of a snowflake, as they say. Politics plays into this, but not as much as you would think. Republicans, are traditionally anti-tax, but Ohio doubled the tax rate. Democrats are very for taxes, but you've got some states with with low tax rates that were Democrat passed. So that's where you start. We're going to want to go find Republicans who are anti-tax and don't increase taxes, and we'll get some votes that way to defeat these things. In the other side of it, we will talk about the effect on the market, as Chad laid out. This is still a relatively young industry, and particularly in states where we have market access agreements. Illinois being one of those. When you raise, those agreements are set based on the expectation of the economic expectation when the bill's passed, and so doubling or tripling the tax rate, like what happened in Illinois, you saw the casinos in East St. Louis that were really affected with this, talking about how they're going to lose jobs, they're going to lose revenue because those deals either have provisions, and I don't see those deals, I don't know what they say, but they have provisions that would take this into account, or they're allowed to renegotiate them because of a material change in the economics of the state. And so, in states with tethered mobile licenses, a higher tax rate is going to have a very big impact on those local businesses, and that's how we'll talk. Ohio, there were deals that fell through. The Memorial Tournament publicly testified about this, so I can talk about it. They had a deal in place for a retail sports book, and the legislature doubled the tax rate, and that deal fell apart simply because of that issue. With the irony, of course, is that Ohio really did sports betting because of the local influence, not because of the sports books. And then by doubling that tax rate, they most hurt those local companies. And we've seen some other sportsbooks pull out because of that. The way you attack it, again, it's going to differ state by state. The other way we're going to attack this, and I know that this is not the topic here, we'll have a different one on this, is we're going to start talking about iGaming. You need more tax revenue, do iGaming. It's 5x or more in tax revenue, and so that's definitely going to be part of the conversation moving forward as well.
Chad, I want to come back to you here. Obviously you cover, a wide variety of gaming interests, online and land-based. This obviously isn't the first time that taxes and tax increase have been a topic in the gaming space. How have markets historically responded to issues like this when they happen, like I said earlier, and sort of in markets that are really material to an operator's business? I mean, no offense to some of the smaller states, but a tax increase in Maine is going to hit differently than a tax increase in Illinois. So, how has that kind of been historically played out in the markets when you see it especially in the land-based side?
Yeah, sure. No, I think, generally speaking, I think states have done a really good job holding tax rates. There have been several examples in terms of small changes or, small changes in terms of the overall offering of gaming when other things have happened. To Scott's point of every state is a snowflake, Illinois is a very different looking snowflake than all the other states. So Illinois obviously has a history of running a different playbook. When they talked about, bringing a land-based casino to downtown Chicago, I'd say over 50% of the operators didn't have interest just because they didn't know if those would be the final rules in terms of spending, labor, location, things like that. And Illinois has had a history of changing the playbook, and they've done so here for the land-based market, for the digital market, and then also for the distributed gaming market as well. I'd say, yeah, look, generally speaking, I'd say smoking was kind of a big thing in terms of changes. That's not a tax change, but that was a big change over the past 20 years in states, and there was an impact early on for some of those companies. Years ago, it would be a 20% impact to the business. So then companies would adjust the full-time employees, the labor, obviously the tax revenues would come down. They would adjust down their promotional spend. And then, yeah, more recently, there have been a few states that have changed the land-based gaming tax rate or implemented a kind of a laddered or progressive rate similar to what we've seen in Illinois. But yeah, I would say most companies run a business to a gaming margin. So you have a couple items that you can tweak there. The big thing has been promotional spending. In the land-based world, I'd say promos are about historically 20 to 30% of gross gaming revenue. And then post-COVID, that's come down probably 500 to 700 basis points. So now we're looking at promos being in the mid-teens, I would say, for land-based businesses. And that was a big adjustment that companies have made to meet some of the financial targets. So we would expect, yeah, a similar thing for the digital world. Promos as a percentage of GGR are, let's go with 3 to 4%, or as a percentage of hold. The big change that we've seen, obviously, is when all these bills were implemented, everyone was talking about sports betting as a low hold business or a low margin business, and we were all talking about 5 to 6% holds. Now that we're seeing 10 to 11% hold, obviously that promo as a percentage of hold has come down. So yeah, it's yet to be seen if they'll have to make adjustments there. But yeah, I think, look, it's a phenomenal industry. Here in the US, there have been fewer changes than in other markets, whether it's Asia, Europe, Latin America. So I hope, the legislators and the regulators understand the consumer protectionism side of this and the investment that these companies need to make that eats away at their margin that could deteriorate if tax increases are implemented.
James, I want to come to you next here because Chad hit on something that I wanted to ask you about, and Scott, I'm probably going to come to you about this too, is, sort of the evolution of how, we talk about sports betting in terms of hold rates, and how things like, the popularity of parlays and in-play micro betting becoming the more popular forms of sports betting compared to, the traditional, Nevada-style sports wagering, have really sort of changed the conversation around tax rates. So how do you think that evolution really has changed this conversation?
Yeah, again, with that caveat that everything's state specific, to an extent, having the conversation around tax increases in different states is the industry to some degree being a victim of its own success. I do think that sports betting operators and aligned stakeholders had tremendous success in particularly the first 2 years after Supreme Court ruling of advocating for competitive, modest, low, pick your adjective, tax rates. The argument was well made in many states that sports betting was a low margin business of 5%, and that therefore the appropriate tax rate was 10% or lower, and 10% of NGR, so the 10% post-promo deductions rather than GGR. There's a number of states that adopted tax rates in and around that percentage. Some that didn't, including Illinois, actually. But as a whole, the industry was successful in advocating for lower tax rates until it rocked up in Albany, and the narrative very much changed there. So I think in some states it is fair enough and not necessarily unexpected that lawmakers or the state budget offices might ask the question, well, we agreed to a 10% tax rate when we were told that the margin on this on sports betting would be 5%, which was again fair at the time. It was looking to historical average in Nevada, rather than mobile-centric markets in other parts of the world. So you may well see states consider readjusting the tax rate on the basis that margins are 10, 11% rather than 5%. Having said that, I do think that's probably a secondary or tertiary factor. I think that might be an argument that the state will return with to justify a decision to increase the tax rate, and the industry objects to. I think it might be sort of an argument to come back with as to why a tax rate should be supportable. I think it won't be as much of a driver as the broader budgetary needs of states. States looking at their neighbours or states they consider their peers that have higher tax rates than they've agreed to, and then potentially concerns around advertising and responsible gaming we've seen as a driving factor in Ohio. I think those three issues are the bigger drivers of states to reconsider their tax policies, and the margin question is probably more likely to be a supporting argument that will come up as the industry sort of seeks to make its own case to keep taxes as they are.
Yeah, Scott, I'm going to turn to you next as the man tasked with making that case. How has the conversation changed? From your perspective in terms of, like I said, 2018, we're having a different conversation regarding hold rates than we are in 2024.
Yeah, I mean, that's, as Chad said earlier on, in 2018, 19, 5%, that's the hold. That was the understood and expected hold rate, and all of the math that we did on tax rates and everything that was at 5%. Of course, we're double that now. The conversation has evolved. When you go back to those early states, again, who tend to have lower tax rates, there's a lot of those states where tax revenue wasn't a factor when they passed this. I'm just looking at a map here real quick. I mean, Tennessee and Indiana, Ohio, ironically enough, Iowa, those. We didn't talk about tax revenue when we were talking about passing sports betting. We talked about, freedom of adults to spend their entertainment dollar as they wish. We talked a lot about the illegal market and combating the illegal market, and there was a very real belief by legislators that because we all know somebody who bets, right? We've known this a long time. That was not a hard argument to make, that there is a thriving illegal market happening when these states pass these laws. That's changed now, of course. Ohio doubled it again, not because they were looking for money. Tennessee's 20% tax rate when they passed it wasn't about the tax money. It was about a sin tax. And if I'm going to let some sin come into my state, I'm at least going to get a little bit more out of it than what was, I think, in the bill previously, which was 10%. And so, we are going to see that sin tax issue come up. Even Republicans who are anti-tax are okay with sin taxes. Just ask the cigarette lobby, who for years and decades fought tax increases everywhere. And we're out of state in most places. So, again, we're going to rely on those local inside folks. I think the last point that we really need to keep making, particularly in these states that have already passed it, is that illegal market's still there. As I think somebody said earlier, FanDuel and DraftKings tend to be, depending on the state, 1 and 2 by a fair margin. But we forget that probably number 3 is Bovada. And maybe not Bovada. Maybe I'm using Bovada as a placeholder here, considering they're pulling out of states now, which is a good thing. But that number 3 market, the number 3 market participant in every state is the illegal market. It's not these other regulated sports books. And so, when you change the economics for all of the regulated market, you're gonna drive folks back to the illegal market, and that's going to continue to be a conversation that we're having with legislators.
James, I guess the next question would be, what if we are looking at a possible trend? What states specifically do you think people should be looking at, I guess, going into next year and maybe the year after, next 1 to 2 years, as sort of bellwether states to sort of answer this overarching question?
Okay, I think the first thing is we don't know for sure. I don't think the all these factors that we've spoken about have yet to play out, and have to play out state-specific basis. But I do think that as we looked at together at Vixio as part of our recent sports betting outlook report, zeroed in on a few indicators of which states which indicators would make states more likely to consider tax increases and how likely those would pass. So I think that's the key thing, is really to flag what are the things that should make the industry and others really sit up and take notice as to whether state a tax increase is a real concern. I think number 1, we talked about Ohio and Illinois. Those have both been tax increases that have been driven by the governor of each state via the state budget process. I do think that tax increases on sports betting, on gaming in general, more likely to be enacted through budget bills than as standalone measures, and to get over the line, more likely to have to come, if not from the governor, from the executive branch directly, then coming from a Senate president or House Speaker, someone with real influence to steer the budget bill to final conclusion. That's what we've seen in Ohio and Illinois to date, and I do think it's going to be important to differentiate going forward between proposals that come from the top than individual bills or budget amendments filed by rank and file senators or representatives in different states. New Jersey and Massachusetts both have legislation or have considered budget amendments this year that have come from a member of the legislature, whereas those that have been enacted in the past 12 or so months have come from the government via the budget process. So that'll be the first thing to watch out for, is who is proposing this, and start with the top, I think. Second, no surprise for everything we spoke about here, how much of a budgetary need is there within a given state. Not so much factor in Ohio, but certainly in Illinois, states will look for new sources of revenue, of which taxes on gaming, taxes on sports betting is one of them. So not surprised that states that have a bigger need to raise revenue, more likely to increase taxes on gaming in the future. Then obviously a third factor, third indicator. Which states have low or low tax rates and initial adopters that adopted tax rates that are on the lower end of the chart you see in front of on the screen there, or they're materially lower than neighbouring states or states they consider their peers. That was something that Governor Pritzker flagged in Illinois without naming the state in particular or states, but large markets, we looked at other large markets and what tax rates they apply and consider their positions accordingly. And then fourthly, it's something that Chad spoke to specifically with Illinois. Does the state have a history or precedent of applying a higher tax rate to gaming in general, and or a past track record of increasing tax rates on gaming to generate revenue? So yeah, I think that those are all indicators that I think sort of go into an analysis of how likely are individual states to pass increases on taxes on sports betting going forward. So trying to not triangulate, because there's 4 factors. Rectangulate those factors and think about specific states. You can point to Michigan as being a state with a really quite low tax rate on sports betting, and I think that could be a contender. Counter argument is, well, sports betting tax revenue is pretty low in Michigan. The state is doing really quite well from a tax revenue perspective outside from the iGaming side. So I think that has to be considered in aggregate. Would Michigan change things on sports betting if it disrupted a bigger slice of the pie on iGaming? I'm not sure. Pennsylvania will be one to watch, probably less so than less so on the headline rate itself than maybe its treatment of promos. Could be something there, but again, thinking of other counter arguments why Pennsylvania might be a contender. There are other revenue raising opportunities from gaming, gaming machines, skill games in bars, probably the central point of the conversation. More to be gained in other areas of gaming than sports betting. Maryland, potentially. We've raised iGaming. iGaming has been floated in Maryland as a revenue raiser for education. If iGaming is not going to happen, sports betting happen. Maryland is a state that has a historically high tax rate on land-based casino gaming, possibly kind of state where this could come up. And finally, would put Indiana on the table, basically just because it's bordering states, and the states it historically competes with on the gaming front are Illinois and Ohio. So the factors I think are more important, and thinking which state fit those profiles is something that we're trying to do. But the two points I'd raise there, none of those 4 states I mentioned are as compelling as Illinois. If you asked me a year ago which state would be the most likely state to increase taxes on sports betting, I would have said Illinois immediately, largely to Chad's point of its past history of raising tax rates on other forms of gaming in times of budgetary need. So I don't think there's anything that's locked in, but the factors are important to bear in mind. And you said about looking ahead. I do think that we will know more about this. This is not an imminent conversation. A critical period, I think, will be when you see budget proposals being made in different states. Different states operate on different legislative calendars, but in a majority, the fiscal year runs July 1st to June 30th, and often you see governors put budget proposals on the table February, March kind of timeframes, and then budget bills get negotiated and in theory approved prior to the new fiscal year. So I think the key thing to watch will be bearing those factors in mind and looking at any governors or legislative leaderships that make their moves on this around the budget making timetable of a given state in the early part of 2025, and then again in 2026. I think this will be quite cyclical and tied to the budget process. So that would be my sense of that. But I don't think it's something where you can rank definite contenders or flag definite contenders. I think this will be the range of factors that go in, and the key thing will be the budget processes as they move forward on an annual basis.
James, you make a great point there, that when you do this in the budget process, just from the way that the budget gets put together, you're going to have folks who may be anti-tax who are going to vote yes because they got something else in. These budgets are very large documents that cover, hundreds if not thousands of different things. That makes the politics of that vote very, very different, and how we've seen it so far. I will say, and I agree with your list, James, but Michigan has a particular procedural rule that you cannot raise the sports betting tax in the budget in Michigan. It's got to be in a standalone bill, and so that's going to help us a little bit. Doesn't mean that the same factors and folks pushing for it, will be the same if it happens, but there is a procedural help there in Michigan that it will not be in a budget bill.
And there is a pretty small handful of states, but in some states, the tax rate is a constitutional part of a constitutional amendment. Right? So you'd actually have to go back to the voters and change it. I think Colorado might be one, although some states there was a constitutional enablement and then a piece of legislation that came after. So state specific, but there are the legislative procedure of adopting a tax rate can be different state as well. So I think the theme continues that this is a state specific question.
We'll be coming up on about 15 minutes left, and I wanted one last plug to get any questions from the audience. I've seen a few trickle in that I definitely want to get to. But before I do that, I just wanted to, Chad, I wanted to come back to you, and this is kind of a little bit of a left turn from what we just were talking about, but sort of, the areas of focus, I think, in the investor community, when it comes to a lot of these sports betting companies, it's kind of been a moving target. A lot post-PASPA, where initially the market seemed to be looking for growth, users, market access, M&A, and then to profitability being the only thing that anybody wanted to see. So I guess, what are the signs that you're looking for in a healthy operation at this point in the process?
Yeah, thanks, Matt. Yeah, I think you hit on some of the items. Obviously, growth is the biggest one. Most analysts have anywhere between 20 to 30% growth through 2030. Most of that has come from new states legalizing either on sports betting or on iGaming. That's on the top line. And look, we're seeing higher penetration levels within the states. I think it's been quite positively surprising how some of these mature states continue to grow in terms of spend per adult and just the number of adults. We looked back at the United Kingdom, which actually had 13 years of growth after they legalized. And that was a good, testimony in terms of what we can see here in the US, where maybe maturities several years after a launch. So growth is the number one thing. Profit, as you mentioned, we have companies like DraftKings and MGM. They both gave 2026 EBITDA goals. So that's something they've really been focusing on. And those goals have been under the current environment, right? Under the current amount of states. Here's what we think we can get to. Caesars did it for 2025. So they have these multi-year targets, and that target is really a product of scale, right? So reducing sales and marketing spend, getting positive flow through from revenue to the bottom line going forward, given a lot of the additional revenues will come at lower costs. So yeah, I would say generally, investors are looking at growth, they're looking at profits in the next couple of years. And then, one thing that I think is interesting right now in the stock market is the S&P 500 has been trading around 22 times earnings now for roughly about a year. And but there's two different camps. There's the growth camp that are trading at 30 times price to earnings, and then there's the value camp that are trading at 15 times earnings. So there's a huge dichotomy in terms of how investors are looking at just publicly traded companies. Obviously, the online gaming companies are on that growth track, and then I cover over 20 other companies that are looking at retail business that has been flat for 4 consecutive quarters. And those companies are trading closer to that 15 times. So yeah, I think this is a segment that investors have been really happy to put pencil to paper, do some work, look at the long-term business model, and then they're putting them in the camp of growth software types of stocks.
Scott, I want to come back to you. We talked a little, and you mentioned a little bit earlier in terms of potentially iGaming being one of the fixes for a budget rather than raising taxes. How does the issue of tax increase relate to lobbying for other gaming related issues, whether it be modifications to existing sports betting, iGaming, other verticals? One thing we see a lot when it comes to gaming is, once a gaming issue comes up, the whole thing opens up. So everything comes back onto the table for discussion. So is that a concern when it comes to, formulating a plan when it comes to lobbying for other types of sports betting or gaming changes?
Absolutely, yeah. The sort of the law of unintended consequences. When we first started doing this, and I've represented DraftKings and FanDuel since 2015, so we were doing fantasy sports bills back then. But even with sports betting in the early days, one of the first things we had to do was convince the casino lobby that it's okay to have a bill that opens up the casino statute, because they would just kill them, just because we don't want anything opening up the things. Don't mess with my statute. Don't even think about opening up. Yeah, we'd be for that, but we're still opposed to the bill because we don't want to open up the statute, to the point you just made, Matt, that once you open up that statute, you don't know what's going to happen. In order to do iGaming, we're going to have to open up these statutes, and I do think that the money there outweighs this idea of unintended consequences. But it's out there. I mentioned earlier that for both, frankly, it was true of both Ohio and Illinois. When the tax increase was first mentioned in Ohio in the budget, that the budget document that he proposed to the legislature included the tax increase, but he didn't score it, meaning he didn't actually use any of the tax revenue from the tax increase in his budget. In Illinois, we were told early on, don't worry, it's a placeholder. It's one of a list. To the point, once you get on this list, it's hard to get off, and it's going to be a continual annual thing. Whenever you talk about gaming and what's happening in gaming, this tax is going to be part of that moving forward. So, we're going to need to change that narrative a little bit. Talk about iGaming in states where we think that it would really make a difference, and there's a chance. Maryland and Indiana are 2 big states where we think iGaming is going to get a real run this year in 2025. And so, if they're truly just looking for money, and both states have robust gaming already, that's going to be a much better option for them than raising taxes. We're seeing it in Michigan. You mentioned it, Michigan. The tax revenue from iGaming is 10-15x what the tax revenue from sports betting is. And so, we've got real life examples of why that's the way to go here, not to raise sports betting taxes.
Awesome. I want to dive into some of the questions that have been rolling in, and one I think actually kind of hits in that same vein. Is there any concern about about tax increases? This conversation being replicated in other verticals, talking about daily fantasy, iGaming, anything else that fits in the I guess I'll expand that, I guess, to like VGTs. We saw in the Illinois bill, there was a VGT tax increase that went with that. So is there any, I guess, is that part of the conversation, or is this, do you think, isolated to sports betting given sort of the high wattage of that topic right now? I'll open up to anybody.
I'll start with that quickly, Matt. I would say on the land-based side, I don't think there's going to be any contagion, right? We've had growth that's about 15% higher than pre-COVID. However, as I mentioned, the past 4 or 5 quarters, we haven't seen any growth in terms of the retail revenues. Visitation is still down compared to pre-pandemic, except for in Las Vegas. And land-based is, that's the biggest piece of the pie, right? That's an 80 to 90 billion dollar gross gaming revenue market here in North America. So I don't see anything there. One area that we've been focusing on is the lottery industry. So I think iLottery. It's only legal in roughly a dozen states here in the US. The retail lottery industry actually remains stronger in terms of purchases than the land-based industry. So we're seeing GDP plus type growth in the lottery industry, and it's still an analog business, right? You still have to go to a convenience store to buy a lottery ticket in most markets. There was the courier market that kind of opened up, and that kind of led to DraftKings acquiring Jackpocket. But I think that could be something interesting, to keep an eye out for. The iLottery space. Maybe there's a slightly better model in terms of introducing iLottery at a higher tax rate, and then just more, regulation, to your point, on sweepstakes, on fantasy. But I don't think there would be tax changes, maybe just some more regulation or putting a closer eye onto those businesses. That's my view.
Yeah, there needs to be some education as to the different economics between the various gaming verticals. Mobile sports betting economics are very different from VLTs or retail casinos. And as Chad mentioned, retail casinos, every time you talk to a retail casino lobbyist, the very first thing they ever say is, we've invested X billion dollars and we have X hundred, thousands of jobs. That's the very first thing they say every single time they talk. I would too if I represented them, and that helped. That inures to the benefit, obviously, when you talk about tax increases and changing the economic benefits of it. In states where I think they're a little less sophisticated, you might see some things move across the board. I was involved in some sort of, I don't think it's behind the scenes, but some non-formal conversations in Wyoming where they were talking about equalizing the tax rate across all gaming, not because they wanted the revenue, because they just thought that was fair. And I think once you educated them on, VLTs and skill games they have there is different than sports betting, and I think that issue's gone away. But there is some education required out there. Legislators, even legislators in gaming states, don't understand all this very much, and so you just got to make sure that you get to them and you talk to them about the economics.
I think there really isn't enough iGaming states at this point to have too much contagion from sports betting tax increases into iGaming side. Industry, I think, would be willing to file that under a quality problem if that was the case. And the states that have legalized iGaming, most of them, they have actually already appreciated, I think, the different tax rates that can be applied. So not much of a delta between the two tax rates in New Jersey, but much higher tax rate in Michigan, higher tax rate in Pennsylvania, also in Connecticut, even West Virginia. So I do think there's already been an appreciation that iGaming can withstand higher tax rates generally than sports betting. So I don't think that's quite as much of a factor at this point in time.
This is another one I'm going to tweak a little bit. The question is, what are the implications of these tax increases for companies looking to enter into the U.S. market? I'd also kind of add, and also those who are possibly looking to exit the U.S. market and potentially speeding up that exit. Plug for me, I had a story that published on Gambling Compliance this morning about some of the recent market exits we've seen from the U.S. sports betting market. So I guess that's kind of a two-parter. Does the concern about tax increases have a chilling effect on those looking to potentially get into the U.S. market still? And does it have a potential speed up effect of companies saying, yeah, this isn't for us, if A, we're not producing much revenue, and B, the little revenue we are producing is now being taxed at a higher rate? I mean, Scott mentioned the basically killing a deal in Ohio for a retail sports book, could we see more of that as a result?
My view would be, look, I think it matters if it's a uniform tax rate versus a progressive tax rate, right? So for Illinois, the biggest impact is going to be felt by FanDuel and DraftKings, and less so for some of the operators. So if it's a model like that, where if you're making under a certain amount of revenues, that doesn't really change a specific company's opportunity to get into the market. Actually, maybe in some ways it increases if FanDuel and DraftKings decide to adjust their sales and marketing and their promos. Maybe it's an opportunity for some of the smaller players who want to get to low single-digit market share. Maybe it provides the opportunity there. But yeah, I think going back to the core point is, all the other cost items of a digital business model, whether it's sales and marketing, whether it's payment processing, engineers, a platform, right, risk management, all those other items, those costs have not gone down, right? So kind of going back to the point, if you want a business model that has 20% bottom line margins, which is what we've seen in most global markets, the tax rate has to be reasonable. So yeah, for those potential sleeping giants that we've all been whispering about for the past years that haven't come into the market, I think they really need to take another look at their business model and figure out if taxes are going to be higher, what are they going to adjust in terms of their structure? Maybe it changes how they're thinking about vertical integration, right? Owning your own player account management and your risk management versus leasing. So I don't know if it changes the number of companies that come in, but it certainly changes internally how those companies are thinking about the long-term financial opportunities there.
Yeah, the old adage, business craves certainty. The market went into Pennsylvania with the mid-30s tax rate, knowing that and preparing for it and planning for it in their economics. But a switch from 10 to 20% in Ohio is a really big deal because they had all planned for 10% and then went to 20. And we mentioned the Memorial. There's other deals anecdotally that I'm aware of that were affected by that as well. And so, and you're seeing sports have pulled out of the state of Ohio for reasons more than just the tax rate, but that's certainly part of it. And so, yeah, I definitely it doesn't help, I guess is the answer, Matt. High tax rates, you may be able to plan for it, but if you're going to try to break into a very difficult market, the less you're paying to the state, the less you're paying to market access agreements, those sorts of things, the more you can put towards promotions and advertising and building up that customer base to try to actually make a real go of it.
All right, awesome. Well, we are coming up on 11 o'clock, so I will let everyone get back on with their days. Thank you again so much to Scott, Chad, James for joining us. This was a really great conversation. And thanks to all those of you who tuned in for it and those of you who are checking out the recording later. Again, if for more information about Vixio, check out Vixio.com. As like I said, we've got some really good free content on there for you and learn more about our platforms. But again, thanks to everyone on the panel and thanks to everyone for joining with us, and have a great rest of your day.
Thanks, Matt.
Thanks, Matt. Thanks all.